Deputy Owen Murphy, 10 minutes.
Thank you, Chair. Thank you, Mr. Vice Chair. You're very welcome. I want to look at the area, if I may, of the wholesale markets and wholesale funding, and that strategy pursued by you when you were there. If we look at Volume 1, page 106 of the evidence books, this is so page 106. If you look at point 8.1 on the funding model, you see it halfway down. The group's lending book grew aggressively from 12.9 billion in 2001 to 39.2 billion in 2007. This growth was largely funded through the wholesale markets. So can you tell me a bit about that strategy and why you decided to pursue that?
Well, as I said, the broad strategy of the group in terms of funding was to fund through customer deposits, which were about 35%, and then to fund through long-term debt and securitization. And, you know, between the three of those, it accounted for about 65% of the total funding. And we considered that the remaining 35% in short-term funding, short-term funding, a variety of sources, a very large, wide variety of sources, we considered that that was a reasonable amount to be funding on a short-term basis. Okay. So that was the broad thrust of the strategy, and I think you may have heard that this morning.
Yeah. But was it intentional, though, that wholesale funding would increase, as it did aggressively, as it says here in the document, but at the same time funding sourcing from retail deposits would fall? I mean, were you intentionally changing the balance, changing the mix?
Not particularly, but it reflected A, the level of growth to fund customer requirements, and B, a very, very competitive deposit market, retail deposit market, where it was very difficult to. There was a tremendous amount of competition in the retail deposit market.
Indicative of you deprioritising retail deposits? No. Okay. And in terms of the risks associated with that increased share from the wholesale market, were you aware of those risks? Is it something that would be in front of the board on a regular basis about this increase?
Well, the board received on a half-yearly basis a review of policy and the extent of funding and all that sort of stuff, and that was part of the discussion. But as I said in my opening statement, we viewed the opportunity to fund in a wide variety of wholesale markets as a really attractive part of joining the euro, when we look back, and at the time, wholesale markets, I won't say they almost looked invincible. Now, with hindsight, they weren't. And in particular, I come back to this point that, I do acknowledge that this is a significant error. That we did not recognise the risk that if confidence left the Irish banking system, markets would all close just like that.
This is an interference there, Deputy, coming near you. It's somewhere from your proximity. It's not always the person who's speaking, it's just people in proximity, so I'd ask them really to deal with their phones. Sorry, I don't know for the disturbance there.
Sorry, thank you. And so just staying on this page and just moving down to that paragraph, the sentence, the group's position was highly precarious in 2008 due to its high level of short-term funding and therefore its high loan-to-deposit ratio. Do you accept that? That's why the group found itself in a precarious position in 2008?
Well, I've already said that.
Yeah.
I've already acknowledged that.
Okay. And do you accept that happened because of this change in the mix of funding? And this, what it says at the opening of the paragraph, aggressive move in the lending, to grow the lending book using the wholesale markets?
With hindsight, yes.
Okay, thank you. Just then, related to that, but slightly moving aside, is the stress testing that would have happened then. As you embark on this new strategy, or you see the wholesale markets and the potential that they offer, what kind of testing were you doing against this new source of funding in case of a downturn, in case the markets were then closed to you? a particular market abroad or the Irish market here, or whatever might happen?
Well, I'm not sure whether this morning you covered that with my colleague. There was a. If you just bear with me for a second, if I can find his statement. No, hang on. No, I'm finding it difficult to find it.
Sorry.
I'm referring to Mr. Gantley's witness statement from this morning.
Oh, Mr. Gantley hasn't appeared.
Oh, he's not appeared.
I haven't heard of it.
I'm sorry. I apologise. I apologise. That's
confused.
I believed obviously in the. Hold on. If I'm allowed, am I allowed to refer to it?
Mr. Gantley being here anyway.
Okay. Before I respond specifically, this was not a deliberate strategy. You know, a switch from, we did not deliberately say we don't want retail deposits anymore, we just want wholesale funding.
But strategy then, does it happen by accident? Is that
No,
the implication?
it happened because we had a funding plan. We had to have a funding plan to meet anticipated growth.
Okay. The funding plan then, was it a strategy then I mean, it was deliberate, you made these decisions.
I take that point, yes. Now, wait a second. Yeah, there was a, excuse me for reading from this potentially. We introduced an updated liquidity policy in October 2003, and this was based on the Basel Committee on Banking Supervision's paper, Sound Practices for Managing Banking Liquidity in Banking Organisations. And there were three, and essentially this was looking at contingency funding. And there were three specific examples. One was a moderate entity-specific crisis. In other words, this was a crisis just about us, and some money had gone astray or something like that. And an unexpected cash flow problem, only likely to last a few days. It was presumed under this scenario that wholesale and retail deposits, short-term paper funding programs would remain intact, and that we'd sell off liquid assets to meet the thing. A severe entity-specific crisis which affected our ratings, and this would have been where we would have suffered a major downgrade, 2 notches on long-term and 1 on short-term. And it was assumed there that unsecured sources would be severely affected. Scenario could take weeks to possibly 3 months to stabilise, and it was anticipated not only would we use our liquid assets, but we would use securitization, the eligible collateral to do that. And the final one then was an industry-wide crisis where there are liquidity problems in the banking system as a whole, causing widespread disruption to markets. The best defence is described as maximising our ability to deal with stress under scenario 2. And under that scenario, we also assumed that the regulatory authorities would be aggressive in providing support to the system, making central bank borrowing effectively the swing factor in ensuring the survival of the institution. And we conducted those tests using the Basel requirements every month, and they were submitted to ALCO, to our Asset and Liability Committee on a monthly basis. So this was not something that we did not consider. We did consider it.
Yeah, and sorry, when did that work begin? The work
it would have begun in 2003.
2003, and it continued right on until you left. Okay. And I mean, looking back then, was it complex enough to deal with the actual funding mix that you had, and the different types of investments and the different type of lending?
To be honest, I find it difficult to answer that question because I wouldn't be sufficiently familiar with the absolute, the complete methodology. But I think that, being truthful about it, I think that nothing would have been sufficient to deal with the actual outcome, because the doors all just shut right away. So I think nothing would have, no amount of analysis, I believe, would have actually tested for that level of stress.
Okay, thank you. And then just in terms of the loan to deposit ratio of the group, you find yourself in a more difficult position or a more precarious position than other entities in the system. I mean, how does that happen for the group?
Well, obviously it happened because I suppose I wasn't around at the time, so I'm speculating to some extent. I'm speculating to some extent. Perhaps it was because people took a more negative view of the asset portfolio of Irish Life than they did of other people's portfolios. That's one aspect of it. So therefore, depositors wanted to withdraw their money more than they might have done with other people. Equally, because we had a very wide we had a substantial reliance we had a substantial amount of short-term funding. That all just stopped straight away. Commercial paper average duration was 40 days. So once the commercial paper market was shut, that was it. So that was what. And I'm not sure that any analysis of this, any stress testing of this, would actually have taken you to where it actually went to.
Okay, and just to clarify, sorry, you shared your stress test.
Deputy?
Did you share your stress test results with the regulator? Was this work passed to them, or was it something you kept in house?
No, this was something that we were doing internally as part of our overall treasury policy and how we controlled our exposure to liquidity problems.
You did see that, or you did say in your statement that you thought the regulators was unbalanced in their approach to the banking sector. So
no, what I said was that the basic defect in the stress test of 2006 was that there was absolutely no view taken of liquidity.
Okay, thank you.